Happy Monday, everybody. Today is March 16th, 2026, and this is your Monday Market Update. Now, before we get too much into the markets, a quick thought to share the week. Markets often feel chaotic in the moment, especially when headlines are coming fast and emotions are running high. But one of the advantage of stepping back each week is remembering that markets rarely move because of just one thing. Instead, they respond to a mix of economic data, geopolitics, investor sentiment, and expectations about the future. Last week was a perfect example of that dynamic. Now let's move into the markets. Let's recap last week and let's preview the week ahead. Markets spent most of the week reacting to a mix of geopolitical developments in the Middle East, swings in oil prices, and key inflation data. Volatility picked up as investors tried to determine how the conflict overseas might affect energy markets, inflation, and ultimately the path of interest rates. At the start of the week, markets stabilized following the prior week's rebound. Investors did enter Monday focused heavily on geopolitical headlines surrounding tensions between the U.S., Israel, and Iran, of course. Oil prices continue to move sharply as traders evaluated potential disruptions to global supply routes. Despite those concerns, stocks managed modest gains as investors waited for clearer signals from economic data later in the week. By the closing bell, the Dow, S&P, and the Nasdaq were each up roughly a quarter of 1%. Tuesday brought more volatility as the geopolitical backdrop intensified. Reports of additional missile activity and attacks on shipping in the region pushed oil prices higher early in the session. Investors focused particularly on whether energy shipments through the Strait of Hormuz might be disrupted. That narrow passage, of course, carries roughly 20% of the world's daily oil supply, which means markets are not reacting so much to the war itself, but to the economic implications of whether oil can continue to move safely through that corridor. Stocks traded back and forth throughout the session as investors weighed those risks alongside the broader economic outlook. By the close, the Dow was down less than a quarter of 1%, S&P down about 1/5 of 1%, and the Nasdaq was down roughly a quarter of 1%. Wednesday brought an important economic update with the release of the February Consumer Price Index. Inflation came in largely in line with expectations. Headline CPI rose 0.3% for the month and 2.4% year over year, while core rose 0.2% for the month and 2.5% year over year. That report suggests that rising oil prices had not yet translated into broader inflation pressure, which was a relief for markets. Stocks did spend much of the day moving sideways as investors balanced that encouraging inflation data with ongoing geopolitical uncertainty. By the closing bell, the Dow was down roughly 0.5%, S&P down less than 1/10 of 1%, and the Nasdaq was down about a quarter of 1%. Thursday was the toughest day of the week for markets. Stocks opened lower and continued to slide as geopolitical concerns intensified and oil prices climbed again. Reports of attacks on tankers and disruptions at key oil facilities added to fears about the global energy supply. At the same time, Treasury yields moved higher as investors reassessed expectations for interest rate cuts later this year. Earlier in the year, markets had expected several rate cuts in 2026, but those expectations have become less certain as inflation remains somewhat sticky and economic growth continues to show resilience. Stocks drifted steadily lower throughout the session in what traders often called a mechanical sell-off, meaning there wasn't one specific headline, as we mentioned earlier, driving the move, but rather persistent selling pressure across multiple sectors. By the close, the Dow was down about 1.5%, S&P was down about 1.5%, and the Nasdaq was down about 1.75%. Friday brought a little bit of stabilization. Oil prices remained elevated, but there were no major new disruptions to energy infrastructure overnight. Markets spent the day digesting the week's developments rather than reacting to new catalysts. Economic data released during the day was mixed, but did not significantly alter the broader economic outlook. Stocks moved modestly higher into the close. By the closing bell, the Dow was up about a quarter of 1%, S&P 500 up about a quarter of 1%, the Nasdaq was up roughly 0.5 of 1%. When we step back and we look at the week as a whole, it was largely defined by geopolitical uncertainty and energy market volatility. Oil prices moved sharply higher at times as investors tried to determine whether the conflict might disrupt global energy supply chains. At the same time, the inflation report provided some reassurance that rising energy prices had not yet translated into broader inflation pressures. Another topic that began appearing more frequently in the market commentary last week was the possibility of stagflation. Stagflation, of course, refers to a scenario where economic growth slows while inflation remains elevated. Rising oil prices combined with some mixed signals from the labor market prompted some analysts to raise that possibility, although most economists still believe it's far too early to draw that conclusion. Technically speaking, analysts are also watching an important level in the market. The S&P 500 has repeatedly found support at the 6550 level. Over the past several months, if the index were to break meaningfully below that level, it could trigger additional selling as hedging activities and stop loss orders accelerate market moves. Looking at the week as a whole, stocks finished modestly lower. For the week, the Dow was down about 1.25%, S&P was down roughly 1%, the Nasdaq was down just over 0.75%. Let's talk about the week ahead. Investors will be watching several important developments. The biggest event of the week will be the Federal Reserve meeting on Wednesday. The Federal Open Market Committee is widely expected to leave interest rates unchanged in the current range of roughly 3.5 to 3.75%. However, markets will be paying very close attention again to comments from Federal Reserve Chair Jerome Powell during the press conference that follows the decision. Policymakers are expected to acknowledge that the conflict in the Middle East adds uncertainty to the economic outlook and could temporarily increase inflation while weighing on growth. Investors will also be watching the Producer Price Index, which provides a look at inflation at the wholesale level. Economists expect producer prices to rise modestly, suggesting inflation pressures remain present but not accelerating dramatically. Other economic data this week will include industrial production, housing data, manufacturing surveys, and jobless claims. Overall, the data should help investors gauge whether the economy continues to grow at a steady pace despite higher interest rates and geopolitical uncertainty. From a broader economic perspective, forecasts still suggest solid economic momentum. Goldman Sachs, for example, currently estimates first quarter GDP growth at around 3%, indicating that the U.S. economy continues to expand, even as some risks have increased. On the earnings front, a few companies reporting this week could provide some useful insight into the economy. Micron will report results, which investors will watch closely for signals about demand-related artificial intelligence infrastructure. FedEx will also report, and its results are often viewed as a bellwether for global trade and shipping activity. As always, markets will remain sensitive to geopolitical development, particularly any news related to energy infrastructure or shipping routes in the Middle East. As we begin the new week, the key themes remain the same: inflation trends, interest rate expectations, and geopolitical developments. While headlines can move markets in the short term, remember, long-term investors are best served by staying focused on their financial plan rather than reacting to every twist in the news cycle. Thanks for watching. We'll see you next week.